Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. It may feel like we're going through a lot right now and it may be scary, but I thought we could just zoom out a little and gain some perspective. Now, most of us have these plans on holding Tesla shares for about another 5 or 10 years and want to really see this through. Well, that's a reasonably long time, and a lot can certainly happen over such a period. There is always going to be ups and downs, recessions and booms. This should not be of any shock. These are the times when the prices differ from their true values, but we plan on maintaining the course no matter what the price, as we see greater riches ahead. And now the stock price is getting low, there should be even more reason not to be selling. Anyway, I don't think it's actually necessary to be looking 5 or 10 years ahead in order to gain some perspective on what has happened with Tesla's stock price. We knew things were going to be slow the first part of this year, ramping up the new factories. Except these factories didn't even come online until later than we expected, and we aren't seeing the progress we hoped for with the vehicle production. And on top of that, the 4680 cell production. It seems to be taking longer than expected and with energy density lower than the previous cell. It almost feels like a bit of a do or die moment for Tesla really. Get these cell lines ramped up and start pumping out some of these new cars from the new factories. This is the direction the future of the company has been invested, the future of these 4680 cells. And although we did expect Q2 to not be amazing, it was still meant to be at least as good as Q1 as far as deliveries. We didn't expect to lose so much production with the lockdowns in Shanghai. We lost a lot of production there, and they're going to be felt severely in the financials. We aren't entirely sure what kind of earnings Tesla is looking at this quarter yet, or what has been priced in, but it's not going to be pretty. However, about the time of the earnings report is the shareholder meeting and the stock split, so it may prop up the stock price. These lockdowns are hopefully all over with, but they have reduced some confidence in Tesla China. Of course, the economy too, but Tesla are working around the clock to rectify all these issues. Q3 shouldn't be so bad, and it sounds like China really is coming back strong. Berlin is also starting to do some okay numbers. Due to Berlin selling the performance version, margins will be higher with that vehicle. I think they are around 5,000 units a month now. I would say it wouldn't be far off break even at around 10,000 a month due to selling the performance version. We expect to see a huge jump in progress with the 4680 cell lines, which will equate to more production coming out of Austin. The Austin Model Y is suddenly better value than before due to the price rises of the long-range Model Y. I'm sure it's going to sell well. Now, I have already made a video on all the positive things we can expect this year for Tesla, but most aren't particularly quantifiable. So to gain some perspective, I'm just going to take an estimate of Q4 deliveries and see if we can calculate the amount of profit that might generate and then relay it back to the current stock price and see if we can use that to make a judgment on the true value of the stock, which I feel has been somewhat lost. Also, I say that everyone thinks Tesla's stock price has dropped about half from its all-time high. Whilst that being literally true, Tesla's stock price today is a drop from Tesla's stock price today, not what it was last year. As in, if it hadn't been for wars, oil, inflation, recessions, or whatever, Tesla's stock price was on a trajectory to hit something like $1,500 by this stage. What with all the progress Tesla have made since the stock price was over $1,200. So I thought I should mention that, as it is something to bear in mind if you're comparing Tesla to other stocks like Apple. Apple is a tech stock and has lost about 1/3 of its value since its high at the start of the year. Tesla has lost almost half its value since that time. But over that period, was Apple growing and expanding and doubling their cell phone production capacity? No. Tesla has been growing at an enormous amount since the stock has crashed. My point is, the market thinks they've punished Tesla, taking it to about half of its value, which is about the amount of punishment the market felt Tesla deserved. But it's not aware it's punished it down closer to 1/3 of its value. My point is, I think Tesla has been overly punished. The market is not taking notice of Tesla's future developments, some that are suddenly going to add $20 billion a year to profit. The market is very impatient right now and doesn't have time to value companies on what they may become. The market is more focused on what they're worth now and has become very short-sighted. Anyway, not to worry, I have the ability to look past all this short-term noise, so I just did a quick estimate for deliveries for Q4. Now, I should point out that Elon seems to think that this number might be even higher for deliveries than I have, judging by what he has said in the past, but I think it's all close enough in the ballpark really, just to gain some perspective as to how different this company will be in Q4 from Q2. I've created my typical table with estimated deliveries and ASPs for Q4. It's quite hard to estimate these new factory ramp-ups, so I think I am keeping it close to a conservative reality. But I get 490,000 total deliveries. If you recall, that is coming from 310,000 deliveries in Q1. In other words, a 37% increase in production from Q1 to Q4. not a particularly massive increase, especially given the increase in capacity. So I don't think we're taking particularly extreme, overly bullish views here. I'm now adjusting each factory accordingly for margin, as I'm not sure what the average margin would have been otherwise. Instead, I'm basing it as best I can on previous margins from other factory ramps at various stages. Of course, I'm trying to also best judge the new manufacturing techniques and the different models. Admittedly, a bit of guesswork, but based on the best reasoning I could think of. And that brings revenue up to $29 billion and gross profit to $9 billion for auto sales. Once we add in FSD and likely regulatory credits, then we are above $29 billion, with total gross profit from auto sales close to $10 billion, giving an average margin of 34%, which does seem a little high, but this is related to the new prices kicking in from the other factories, and the new factories are doing relatively low numbers still, so their lower margins don't affect the average so much. Cost of goods might have risen somewhat from inflation, but we have some serious price rises here. I think these are far more demand-driven prices than inflation, hence why we should see extra margin. Of course, nothing too much to expect from the other sides of the business still, or potentially a little bit of improvement on services and other with all the ex-leased Teslas being returned. You see, Tesla didn't allow the leases to be purchased, they all had to be returned to Tesla, and over the last 3 years, the prices for these cars have actually increased. So Tesla may even be selling these ex-lease vehicles for about the same price they did to customers 3 years ago, which is beyond crazy. Anyway, we might feel a little bit of extra profit in there, taking total gross profit above $10 billion. Anyway, long story short, we're looking at earnings of around $6.5 billion for Q4. Earnings was the number we were looking for. If Tesla can produce that in a quarter, and we multiply that by 4 to give the equivalent of those earnings if annualized, then we're up to $26 billion in earnings. Currently, the stock price is giving a market cap of $662 billion. Now, if I divide 26 into 662, I get the number 25, as in it would take Tesla 25 years of earnings to reach that market capitalization, or what we also call a P/E ratio of 25. Now, I don't believe I've been overly bullish in this analysis. Possibly, if anything, the margins felt a little bit high, but that's just what the math gave us. Plus, FSD is going to have higher margins and the cost of 4680 cells are going to drop significantly. In other words, if anything, these margins are likely to rise. Anyway, as usual, I never tell you when I think you should buy or sell. I just present things to you with the facts that I have and try and extrapolate what they mean. It's up to you to decide what they mean to you. For me, the fact that we are at a price now that is possibly around the equivalent of a 25 to 30 P/E ratio relative to Q4 makes me feel confident about the company's future. It also helps me get the conviction to invest in the company more. Of course, in this scenario, we also have Texas and Berlin likely at under 1/3 their actual capacities, and these new facilities should be responsible for well over half of Tesla's capacity, and they will have higher gross margins. And we know increased gross margins end up being felt even more in net profits, implying next year there could be quarters that are closer to a P/E ratio of 10 at today's stock price. So I hope that helps you gain perspective. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.